Brought to you by the OR Group, connecting people, projects, and capital to fund the next generation of minds. My name's Mark, and you're watching Resource Talk's weekly news roundup for the week ending August the 23rd, 2026. This week, a surprise US Treasury move sent gold and silver sharply higher. A sudden buying frenzy sent copper to a record high. And Washington committed $62.8 million to rare earths projects across Africa as the West tries to loosen China's grip on the market. And joining us to make sense of it all is Nomi Prins, a macroeconomist, author, and former Wall Street executive who's worked at Chase Manhattan, Lehman Brothers, Bear Stearns, and Goldman Sachs. He now runs Prinsights Global, and her work focuses on the gap between financial markets and the real economy, what she calls permanent distortion. And at the end of the conversation, I'll ask her how she would invest $100,000 in this environment. So, Nomi, thanks for being here today.
Thank you so much for having me on.
On Wednesday, the US Treasury doubled the amount of long-term government debt it's buying back to at least $4 billion per operation, just after 30-year yields hit highs not seen in nearly 2 decades. And as a result of this announcement, bond yields and the dollar fell and gold jumped nearly 4%. So, Nomi, what is the Treasury doing here, and why did gold react so sharply in your view?
It's a great way to start out. The Treasury, actually the entire United States government, is in a bind because of the fact that it has now topped over $40 trillion worth of public debt outstanding. It has an over $1 trillion per year price tag for paying the interest per year on that debt and growing, and effectively has less buyers for the long end, as evidenced by yields going up, by prices going down every single day. So that confluence of events requires, from the standpoint of the United States, two possible remedies. One would be a massive quantitative easing operation by the Fed, and we can talk about how that could unwind and what the ramifications or personalities involved there might be. Or for the Treasury Department to step in and effectively do Treasury bond buyback, which is what it has started to do. This is an idea that Scott Bessent, as head of the Treasury, has had for a while, as the debt has been growing, and in particular now it's timely for the Treasury Department to affect that change or affect that appreciation in the amount of bonds that they will buy from their own auctions, because the price tag of the debt, the budget, the war, and everything else continues to escalate relative to the growth in the economy's ability to plug that hole or even move forward in terms of revenue growth to the Treasury. So this is a way to be a buyer. And I think it's the first of many such moves, which will grow in magnitude to take off some of that product, effectively the debt product that the Treasury manufactures, off of the market.
And just a few hours after this announcement by the US Treasury, Fed minutes showed that 3 policymakers wanted to increase rates in July, while several were ready to tighten, and many thought a hike would be needed if inflation failed to come down. But despite those rumors, the Fed is still widely expected to hold in September. So do you agree with the consensus that the Fed will hold rates where they are in September?
I do believe they will hold rates in September, and also those 3 governors effectively were the same ones that when before this particular Fed chair came in, they were already kind of the opinion that language should be changed in such a manner as to allow for more flexibility, to allow for potential tightening. So it's the same 3 governors that have effectively now wanted a rate hike. That's not going to win a vote at the FOMC committee. It's probably going to be the same 3 that will ask for a hike of 25 basis points again at the September meeting, but it's not going to be enough to move the till over to having a hike, given that no one else wants to have one. Now, that being said, obviously there's still a view of what inflation will do. We had it come down last month because oil prices came down. Right now they're up a little bit over where they were into that last CPI figure. However, if they come back down from where they're at now, we're going to see a consistent CPI figure that's not going to indicate a big inflationary move upward. And if that's the case, there's going to be even less of a reason to move rates upward. Aside from the fact, and this is something that we, and I've talked about for years, it's in the book Permanent Distortion, that's something we follow quite closely when we look at real real assets versus markets and versus the cost of money and rates and such, is that the Fed has no ability to actually control inflation. So the idea that just because CPI or PPI is higher because oil is higher and energy prices are higher, and even at the stripped out values that they ostensibly look at are higher because everything requires energy in some capacity. Regardless of all of that, they don't have the ability to, plenish oil reserves or print gold or print silver or create copper. So they really don't have the ability to control inflation. They're stuck in this sort of old, several decade old mindset where they have to stick a 2% inflation landing on the one hand. On the other hand, they can't control that, nor can they control, as we talked about in the beginning, the buyers that are coming in for the Treasury market at the long end of the curve. So yes, I agree with consensus, but for all of these reasons, and also I don't think the Fed really has the ability to control inflation anyway. It's just something they like to talk about, headlines like to cover. And thirdly, the Fed is also looking over at the Treasury Department and at the size of the debt that this country has and recognizing that the higher it keeps rates, the more expensive it is to service that debt and the more deeply negative that is for the overall economy of the United States.
I want to turn to gold. So the yellow metals now rebounded by roughly 9% in August to $4,500 an ounce. But that comes, of course, after it fell from a record 5,595 in January to below 4,000 in June. Now, you've kept a $6,000 target for around year end, I believe.
Yeah.
So does that mean that it's still a good time to load up? And what would have to change for you to abandon that target, to raise it or to lower it?
That's a great question. Yeah, we just reaffirmed that target when gold was under 4,000, that we would still reach 6,000 around the turn of the year. And of course, we have rallied recently. Part of that is because of what we were just discussing on the Treasury side. Part of it's because oil came down. Part of it's because buyers are just recognizing, and that includes central banks as well as retail around the world, are recognizing that whatever happens in Iran, and that could be a very long-term, prolonged situation, it doesn't have the same impact on containing gold that it had in the first few months of the war. And that's what we're seeing now. That's why we're seeing that rally come into play, the dollar trade off a bit and so forth. The reason for gold, and why we believe it will continue to get up to 6,000, why this is a very good time to buy gold. You've not missed, even though you've missed the last 15% rise in gold prices over this month, you haven't missed the opportunity to be involved in gold for this year or for the long term to ride up the rest of that appreciation. What's happening is the central banks are continuing to buy gold. They're only 25 to 30% of the buyers of physical gold, but it really matters to detach how physical gold moves relative to paper gold. And in the situation where we saw a lot of gold trade off and silver even more so in the wake of the war, the volume in paper trading was far higher than the volume in physical buying. And as a result, we saw prices go down because they are ultimately impacted by that paper trading as well. But that doesn't change the fundamentals of supply and demand. It doesn't change the amount of new mines coming into production for gold or for silver. We remain very close to a deficit for gold based on current demand. That's not even rising demand. That's just if demand stays it is, and with the momentum that it currently has with respect to central banks, with respect to asset management funds, sovereign wealth funds, individuals throughout entire banking systems buying gold. If you look at something like China, People's Bank of China, of course, one of the major gold buyers in the last few years, but nowhere near the percentage of its reserves that it was at during the financial crisis of 2008. It still has about 5% more gold to buy, or effectively double where it's at to get to its high levels of gold as a percentage of its reserve. It didn't stop buying at 5,500. It's not stopping at 4,500. It didn't stop last year with 3,500 over, about a year or more ago. So all of those movements are going to happen because they're fundamental strategic moves where central banks around the world and their financial systems that rely on them are turning to gold to diversify, not just against the dollar, which is commonly discussed, and we agree with that, but also with respect to any fiat currency and anything that is going to be created with too much debt and not enough reality beneath it to support that debt is subject to being diversified into gold. for a central bank and also for investors. So this is a great time to buy gold, up to 6,000 this year, up to probably 8,000 next year. We'll have forecasts coming out in January. Of course, we'll look at the numbers. And I'm not moving it up yet this year. But it's also a great time to buy gold miners. It's a great time to buy gold prospectors. It's a great time to buy all throughout the gold chain, because some of those companies have a ton of cash on their books, and they're going shopping for the smaller companies in the gold chain. And there's a lot of really good opportunity there, because gold sold off and hasn't reached back to its historic highs or beyond that yet.
The Ore Group advances metals projects through exploration, discovery, and development with one objective: to deliver the next generation of mines. They focus on what matters most: the right people, the best projects, and access to capital. Discover their companies at oregroup.ca and subscribe to the Core Report for free to receive updates, timely market insights, and early access to updates. So you mentioned about central banks globally turning to gold and that being a factor that makes you bullish on the metal. And in fact, we saw that central banks bought a net 289 tons of gold in the second quarter, which was more than 5 times the first quarter total and a record for that time of year. And in fact, Deutsche Bank estimates that buying in total is worth around $45 billion. But all of that record demand didn't seem to be able to put a floor under this massive sell-off that we saw in gold at the beginning of the year. So how do we sort of understand what happened there? Why did it plummet so much?
It's a really good question. Gold and more so silver, that they plummeted together, and part of that was that there is a distortion, a dislocation between how gold trades in the paper markets and silver, and how it trades in the physical markets, and how it is stored in vaults, and who actually buys it and at what price. And what happens is these two things interconnect in terms of how we see market prices. But for example, silver has a 15% higher price just by nature of the physical additional taxes and value that is required in Asia to buy silver versus where we would ever see it in paper trading. So there's a lot of numbers that come into play for silver and gold that make it so that when there is a run on the paper market, we saw record outflows, or periodic record outflows in SLV for a minute for the silver contract, GDX and gold, and the gold miner contracts, and so forth, because there was a fear, and I think there was a lot of headlines driving this fear, and then there was AI basically accentuating the fear that headlines were saying, and then you'd have a feedback loop because prices were going down so fast, and then you'd have headlines saying prices are going down fast. I remember there was an article, I want to say it was about 6 weeks ago, maybe it was a bit longer. The Wall Street Journal said something about how they, did they hit rock bottom yet, gold and silver? They sort of did play on the word rock. And I knew that if the Wall Street Journal was getting in there and talking about how there was much more free fall to go, we were definitely at the turning point, and we actually have moved up since that. But that was because they were looking at these paper prices. When you sell an ounce of gold or an ounce of silver, it's very different from when you sell a share in an ETF that represents gold or silver. When you get the paperwork for an ETF that you buy, and nobody looks at this, and that's fair. As a retail investor, exchange traded fund, you're not looking at all the little paperwork. But what it tells you is that ostensibly every ounce of silver that is represented in the ETF has 0.9 of an ounce of silver somewhere stuck in a vault, which would mean that the entire exchange traded fund is backed by 1-to-1 almost, or 0.9 to 1 silver. That's not the case. We saw outflows of 45 million ounces in just the week where silver had its worst free fall. And that's compared to 820 million ounces being produced each year out of the physical ground. So the ratio 5 or 6 to 1 is why you can have a sell-off in the paper market that can affect the price temporarily, which is why it's a good buying opportunity, but it doesn't affect how much supply comes out of the ground and the value of that supply over the long term, or how much supply goes from ground to end industrial use or end central bank use. They can't put shares of GDX in their vaults, right? They have to take tier 1 solid high quality gold bars and they have to put them in vaults, and they have to be secure and reserved and tested and of that nature. So there's a big dislocation. That's how we explain it. By looking at the actual numbers, it's much easier to sell paper than it is to unearth physical assets. But the timing was what overshadowed the relationship of those two prices at that moment. And it can reverse. And we're seeing that start to happen now.
Santa Cruz Silver reported revenue up 55% and adjusted EBITDA up 74% year on year, while its realized mining margin per silver ounce more than tripled. But at the same time, its all-in sustaining cost rose 25% and reported net income fell 90% because of tax, currency, and valuation effects in Bolivia. So that company level story is sort of a good example of why a higher silver price doesn't, unfortunately, automatically make a miner sort of easier to value. So my question for you is, when you look at silver stocks, which numbers and risks matter most? And at this point in the cycle, do you think you would prefer to hold producers or juniors or the physical metal itself and stay away from all of the miners?
So I always look at investing in miners and have a very strict selection process because, as you just mentioned, one, yes, some are good at managing costs and the values of their production cycle, and some get into jurisdictional issues and some have tax issues, and some are just not good management teams. So I look at all of those factors. I'll give you an example of one that did quite well, which is Aya, gold and silver. Aya has one of the largest pure play silver mines in the world in Morocco. I was actually out there in April. I was a mile and a half underground. I don't just really cover stuff. I actually go and look at the productions and talk to the teams and feel the output. And they have a processing plant on site and everything else. They have a cost about $21 per ounce of silver. So when silver is trading at 65.70, that's an all-in cost. They're effectively making 3 to 1. When silver is trading at 120, they're making significantly above that. But the difference is also in terms of that positive margin. And they continue to blast. They continue to move their size of their pit literally every day. I was there for multiple blasts. And every time you do that, you get a whole lot of rock, and then you get a little bit of silver. And so you have to have a production cycle where you're disciplined, where you're around the clock, which they do have a 24-hour set of individuals down in the pits and at the processing mines to move your silver. And also you have to have end buyers. And in their situation, their end buyers, even when silver was at 120 and even when silver was at 60 and when it was just down below 59, 58, we're still on the phone trying to get the silver that was produced out of their processing plant into trucks, into ports, into other countries in Asia, throughout the Middle East, and so forth. There was no stoppage of the purchasing of their silver at any price as it was being as it was going through these channels. And it has a fantastic management team. And finally, it has a jurisdiction that supports, and there's a mutual support between the mining company and the jurisdiction on the ground and within the country. The Kingdom of Morocco is very friendly towards mining, and mining is very friendly towards the people of Morocco. Aya has about 85 to 90% of its entire workforce either in the local region or in greater Morocco, and that's from engineers to mining people to marketing people, to quality control. And so what I look at is very complex in terms of the different nuances of, those are just some factors, but these are all things that make a company, not just I, but that's the example I'm talking about right now. It's in our portfolio, but that makes a company like that increase by 3 times over this entire period. When silver was up, down, and all around. When silver was at 35, when it was at 120, when it was at 60, and right now under 70. And so these are the things we look at. Solid jurisdiction, giving back to the community so that you don't have to worry about jurisdictional risk. Giving back to your employees, having longevity in the team, having good quality, and having good controls over your production cycle and keeping your costs down and your customers happy. So yes, I think investing in mining companies like that are very important. We just looked at a mining company, which we recommended at the end of last month, a larger cap company. In Mexico. And I would have said 2 years ago that Mexico is not a good jurisdiction to buy silver, even though it's the largest jurisdiction for silver in the world, because of a lot of risks that were coming into play around mine sites. But then again, there are certain companies where the experience, the relationships, the specificity of their location, the longevity of their supply chain, and just how they manage their operations matter relative to other companies in that same jurisdiction, even. So what I would say to people is definitely own physical. But there are certain things where owning physical and gold and silver are two of those metals where you have to go down the chain if you want to capture that value. And I would suggest for those that are more long-term oriented that you go down to prospect developers, you go down to companies that are basically mining right now, brownfields through areas that already were pre-mined, but larger companies sold them for different reasons years ago, where there is gold, where there is silver, where there is copper, where there is uranium, and companies are coming back in to re-examine abandoned locations that have data that they can use to dig and find new supply. And we look at those factors as well, all the way to the beginning of the supply chain.
Copper hit a fresh record in London this week, but the more unusual part of the story was the gap between what we can think of as copper available now and copper due in 3 months. So buyers were paying an extra $545 a ton for immediate delivery, and this marked the widest gap since 2021, before fresh metal eventually arrived in LME warehouses and eased the pressure. But just having a look at this story out of London this week, um, did you follow it? And what is your sort of takeaway if you were following it for the wider copper story here? Is this something significant or is it just a sort of technicality?
Yeah, I do follow copper very closely, and basically the alleviation of the pressure, the sort of re filling of warehousing for the LME, I think is a temporary it's a temporary fix for the supply deficit that we have in copper. And also the reason for that larger gap is because there was a lot of supply that was being stockpiled in the United States and warehouses physically here because of tariff decisions that were coming up for not just copper, but also for end product copper, so fabricated copper, derivatives of copper, and there was conversations related to that. Of course, copper is a critical mineral in the United States. It's a critical mineral in China. It's a critical mineral sort of everywhere in the world for the extension of wiring of energy systems, infrastructure systems, defense systems. And again, it's a deficit. I think Morgan Stanley just predicted about a 600,000 ton deficit just this year. We actually had forecast copper to get to $7 a pound this year back in January. I think we touched 675, 680. Of course, as you mentioned, there's been a bit of recent supply coming back into the warehouses and that the LME deals with. And so we've seen prices come back a bit. I think that's really just temporary. And in fact, there's a more interesting thing that's popping up because of this temporary abatement in copper prices, which is that some of the copper developers and miners are actually outperforming copper. And what that's saying is that, look, yes, we have a little bit of a technical kind of reinstatement of some supply, but it's really a drop in the bucket in terms of overall supply relative to the needs and relative to like new projects that are coming out of the ground. And actually, that reminds me, we're just looking at Argentina. There's a lot of new really good developments coming out of Argentina, which is sort of popping into the copper market. We always look at Chile, but it's having sort of issues with supply, and that's actually hit the market. That's been one of the reasons we've seen those prices go up towards $7 a pound. And so there's some interesting developments out there. But that's what's happening. It's an interesting metal in that there's definitely a supply demand gap. There's definitely widening structural gap. There's a bit of movement between warehouses relative to very, very specific current need and export controls or other kinds of controls, whether they're tariff or sulfuric acid, which China has controlled, which is something that you need to actually process copper into other types of refined copper products, and that's all hurt. So that's an area there where I wouldn't necessarily buy copper, even though I think prices will continue to go up, but I would buy some of the good projects that are developing or producing high quality copper into a growing deficit.
talking of companies that are producing copper, BHP's full year underlying profit rose 30% to $13.2 billion. And in this earnings report, they noted that their copper division generated 18.19 billion in operating earnings, overtaking iron ore for the first time. And the company says its project pipeline could lift copper output by up to 40% by 2035. So my question would be, has BHP become, with this announcement, maybe a credible lower risk way to invest in copper, or does its size sort of cap the upside there? And where would you rather be when you're looking at copper plays in a diversified major or in a copper focused producer or junior developer?
It's a great question. We actually run two portfolios. One is for sort of larger cap, mid cap size companies that match what we're looking at geopolitically and from a supply demand hard asset perspective, and then also one that's more smaller cap. And that would generally entail some of the smaller developers or producers or mining companies. So we actually do look at both. So to an extent, it depends on someone's risk profile. Now we have BHP in our portfolio. I think for the last 5 or 6 months, we're working into this appreciation specifically in copper. Not knowing what was going to come from their earnings, but recognizing that they actually had a lot of cash on their balance sheet. I was just mentioning Argentina. They actually did a deal recently in Argentina where they bought some projects up and gone shopping with some of that cash, which is something we're seeing some of these majors do. So we do hold it. I think that is a great way to be involved in a less risky way, possibly a lower upside way, but again, to be involved in the sector, depending on one's risk tolerance. And it is a company, and there are many like this, the same thing in gold. And so if we look around that have that money on their balance sheet, that are actively making decisions to buy production rather than to necessarily create it from scratch of companies that are sort of lower down the food chain. And so then to the second part of your question, we're looking at what's lower down the food chain. Well, if BHP is operating now and moving, let's say, on different places, but I'm just talking about Argentina because it's very favorable right now to foreign miners from a tax perspective with the Malay government and so forth. There's a lot of incentives there to buy and to partner up with foreign companies, which BHP is doing. There's other smaller companies there that haven't been bought up yet, but that have good projects. And I would be invested, and we are in those too, because ultimately, probably they may be bought up by the likes of BHP. So you have a lot of that going on in both ways.
I want to turn to rare earths because there was a story about the US International Development Finance Corporation having committed $62.8 billion to rare earth projects in Malawi, Angola, Madagascar, and South Africa. But at the same time, we've got Olympia Pilch, who's the head of strategy at Critical Minerals Africa, who's been saying that there are already now more announced rare earths projects than expected demand for neodymium magnets. So do you think with all of this hype and government incentives around rare earths that we could be heading towards a glut with, maybe private investors who got swept up in all the excitement left holding the bag at the end of it all?
I don't necessarily agree with her statement if I look at all of what's going on in rare earths, because it's not just about buying mines, it's about buying production. And so right now, and also it's about the quality of neodymium, praseodymium, NdPr, which is one of the composites of rare earths that are most prevalent in magnetized products, whether that's in defense or satellites, aviation, space, and so forth. And the reality is that using high grade magnets or high potent magnets, which is what all of these industries do, allows for much higher quality performance in greater heat, etc. So you need to be able to process them. And right now, one of the major things that's going on in the processing component of rare earths is that China is processing about 90% of them. It owns about 60% of the actual raw material, whether it's in mines or in partnerships or whatever around the world. It continues to buy them. It continues to forage into Brazil. It continues to forage into Africa and so forth. It's not stopping with its plan and its strategy to basically be the dominant rare earths player in the world. But as you mentioned, there are others governments that are picking that up. There's been a lot of critical mineral activity in terms of even in July, where there was two orders from the White House that effectively will require defense contractors to be able to say, all right, well, this is where every piece of my fighter jet comes from, and I'm not allowed to use rare earths from China or from non-allied countries, and that's going to go into effect as of January 1st, 2027. The problem is, and why there's still value in all of this, it's not about the existence of rare earths. It's not about where NdPr can be found. It's about where it can be processed, how high the quality of it is in those mines, and who's doing the processing. And on that basis, we're still at the very low end of a curve that could take decades. The United States used to be dominant when there was less of a need for these types of minerals, and it basically let all of that business so much processing, but particularly in rare earths, go over to China. China's taken that baton quite seriously over decades and built that. So in any mine, investors can get hurt, right? In any product, in any mine, if it's the wrong project, when I say wrong, if it's jurisdictional issues, if the quality isn't good, if the management is good, all the things that we were talking about before, there's always risk in any project. But for rare earths in general, it's not we're not overhyping. I think when I say we, I mean headlines in general talking about what's going on in the rare earths or governments trying to command their components of it. But what I think is that the message that gets out is that this is all about just rare earths. It's all about just having them, finding them, and by the way, they're not so rare. Which is a statement that gets said a lot, and that could be true. But what is rare is having the quality, extracting it, having the processing, getting it out to those refineries, getting it into magnets, and getting it to the end result, and that whole chain is very undiversified. So if you're an investor, you want to be serious about being in the rare earth space. First of all, the projects have to be good jurisdictions, good support, good funding, good teams, and also supported by a government or other companies that can produce the refining and the processing capacity and create the end products. We are so far away from that being diversified that again, we look at all parts of that chain. Which companies have plans for processing plants in the United States that will not actually be fully productive for 4 to 10 years, maybe, but that will be a part of the chain. Where are they getting their rare earths from? What's the quality of those rare earths? I'll go buy those mines. I'll go buy into that project. So again, it's about being selective, but I don't think people get caught up because of hype or caught out because of hype. I think it's more a question of looking at the specifics of which ones you're buying.
I want to turn to lithium. Sociedad Química y Minera de Chile, which is a major Chilean lithium producer, raised its forecast for 2026 global lithium demand from about 1.9 million tons to more than 2.1 million, which they say is going to be driven by stronger battery storage demand. And at the same time, we've got LG Energy saying that 5 of its 8 North American factories will be making storage batteries or gearing up to by the end of this year. And this is all part of the narrative around AI data center build out. So do you think that grid storage is going to become the next big driver of lithium demand? And after the boom and bust that already happened in lithium, what would convince you that the cycle has genuinely turned?
Yeah, lithium's interesting because as much as I can be very clear about upside and where it's coming from throughout the chain for various commodities, lithium's a tough one. As you said, there's been a lot of up and downward movements and cycles in lithium. And okay, this time it's going to be in all the EVs, and there's still, for example, growth in that entire sector. But that growth's actually pulling up aluminum prices more than it's pulling up lithium prices at this point because it's more important to build a lighter car than it is to build a lighter battery. And lithium isn't even necessarily the best way way in terms of new technology to do that. So I think lithium is one of these commodities that we actually don't invest in. In fact, I was looking at a lithium company that I've looked at before for our last selection for our last monthly, and I went with silver, and this month I'm going with aluminum. So that tells you where I think that the sort of needs are for grid and just for vehicles and things that would have batteries that use lithium. That said, if there is, if we continue to see, which I do believe, growth in terms of the need for better power grids and high voltage transmission lines and data centers and just where we're going as a society and as a civilization going forward, there will be more demand for lithium. It's just that I don't think lithium is going to outperform is some of the other commodities which are also in demand. So I'm not a huge bull on its relative value.
As we get close then to wrapping up this week's episode, we're trying something new, which is our question of the week. So my thanks go out to username long go where to for sending this one in for Dr. Prins. And the question is, Hong Kong pegs its currency to the US dollar, while Ecuador and Panama use the dollar outright. If the dollar were to hyperinflate, as some of the biggest dollar bears out there are predicting, how exposed are those countries and what could they actually do about it? So that's a question from one of our viewers there, long go where to. So what are your thoughts about that question?
Well, I think that being pegged to the physical currency is very risky either way. And I think this is why, we talk about other central banks being more diversified in terms of trying to find ways to have other outlets net of the dollar and also back those outlets with trade agreements that are settled in their currencies. Something like in Ecuador, it's a very small economy. So from that standpoint, it does so much trade with the United States. I think there's a legacy connection to having the physical dollar be used there. But I think ultimately it will behoove Ecuador and as we're seeing with other countries, to have more of a hedge to the dollar and to have more of a relationship and settling in trades in non-dollar currencies in order to help its economy and also to balance generally just the retail up through banking to central banks of those countries.
And next week, we'll be joined by Joe Cavatoni, who's the World Gold Council's North America market strategist. So leave your questions for Joe in the comments. And Nomi, before we finish, I'm going to bring you into our $1 million portfolio. So every week, we ask the guest on our news show to make one change, and that is to sell $100,000 of something that we already own and then put that money into the asset that they think has the best setup from here. And it could be a stock, ETC, ETF, anything in the investable universe. So let me share my screen with you a minute so you can see what we're holding in our portfolio. Great. I'm just going to give you a moment to digest what we're holding so you can decide what you'd like to sell. And I'm going to remind our listeners of the recent trades in this portfolio. So, talking of the dollarization of Ecuador, we actually had one of the chief architects of that, Professor Steve Hanke, who bought gold and he sold bonds in order to do it. We're down 6.7% on our gold holdings. We also had Simon Hunt on, who bought gold, Lance Roberts, who bought the S&P 500, which has since been sold off. We had Doomberg, the pseudonymous green chicken, who bought Energy Transfer. And looking at Energy Transfer, we're up 7.7% on that. We also had Tavi Costa, the very patriotic Brazilian, who bought the iShares Brazil ETF, which we're down 2.8% on currently. We have Michael Howell on, who bought an agricultural ETF, which we're up 7.2% on. And just last week, we had Henrik Seberg on, who bought, much to the chagrin of our listeners, a Bitcoin-related stock. He bought Bitmine Immersion Technologies, although he must be feeling very smug because just a week later, it's up 11.2%. So, Nomi, then, having a look at all of our holdings here, What do you not like the look of? What would you sell $100,000 of, do you think?
So, well, your current values are not, I mean, if I had to make it be 100, I mean, you've got IBM in here. It's a nice little dividend stock, but I think we could, probably move that into a uranium stock. Because I don't see any uranium stocks here, and I think that the mining companies in uranium have interestingly so far underperformed uranium, which is held in rock solid in the mid to high 80s level throughout all the other volatility in different types of assets. So I would be inclined to get rid of IBM and buy something like UEC.
So we had that was Clem Chambers who bought IBM, and he said your portfolio is lacking AI exposure, and that's
Okay.
why he bought IBM. Do you disagree with that then?
I understand it, but I am much more of a hard asset person, and I know that IBM needs nuclear power to continue to run its AI development. So I actually look at fuel assets as being AI positive, but if so that's how I look at IBM.
All right,
That
great. So
said.
IBM, we'll chuck IBM out. What else are you going to chuck out then? Because we need
You
$100,000
need a
to.
hundred, right?
Yeah.
Um, so I would take, 'cause you've got a pretty heavy technology thing. You've got 111 at BMNR. You're pretty good on silver and gold. You have a little bit of copper. I'd be inclined to take out, uh, let's say half of the DBA position. It's agricultural. So I think I would be inclined to take half of that out and to move that into um, probably a copper company. I know you have FCX there. I'd be inclined to move into like a BHP, like a diversified copper company, and sort of have a bit more exposure there.
Okay, so you want to sell half of our agricultural ETF holding, which was bought by Michael Howell. So does that mean that you're bearish then on the outlook for agricultural commodities from here?
Well, I think agricultural commodities have more volatility in them and less of a sort of overall, especially in a fund, supply deficit issues. And I would say for copper, diversified base metals.
Okay, excellent. All right. So just to sum that up then, so we're selling off half of our agricultural fund and moving that into BHP, and we're also selling off, what was it? Sorry, IBM, right? To
We said
buy a
IBM.
uranium miner, you said, wasn't it? Which uranium
Uh,
miner was it?
I said UEC.
Okay. All right. Excellent. So thank you very much for your input in our model portfolio. We'll make those trades. We'll be tracking it every week.
Okay.
And Nomu, before you go, would you like to tell our listeners about where they can follow you and your work and keep up to date with all of your movements?
Sure. So, best place is my Substack, printsites.substack.com. We run a couple of different portfolios or model portfolios. And when I say run, I mean provide a lot of analytical support, updates, recommendations across the value chain in the hard asset space.
Amazing. Well, Nomi, thanks again for coming on the show, and we hope to have you back again soon.
Thank you so much.